Previously on Wombat Politics. In the last episode about super tax policy, we learnt that the government does stuff all for minimum wage earners, whilst handing hundreds of thousands of dollars to high income earners. We then learnt that the minimum wage earners should be thankful because they are way better off than low income earners like Maggie and some primary carers. Before we start part 3, we have some viewer feedback. Daryl from Udina Data writes, "Dear Wombat Politics, they are really taking the piss stealing off Maggie like that. I talked to my mate Bazza, and he just says all politicians are the same, and didn't want to know anything about it. Isn't that the problem though? People using throwaway lines and putting no effort into understanding that politicians and their policies are very different. I said to Bazza that it's the voters that are all the same. He said, get Kind regards, Daryl." Thank you, Daryl. On to part 3. Super tax policy is awfully complex and enormously tough to summarise. This is not by accident. We can prove that there are layers of unnecessary complexity for no good reason. The best example of this is deeming and the asset test. Refer to page 72 in the Retirement Income Review. Deeming and asset test are calculations used to means test the age pension. Both are applied with the higher one used. Both calculations assess a retiree's cash and cash assets. Cash assets include shares, bank accounts, investment property, and importantly, super balance. Basically, all assets are included aside from your personal home. From this, they determine how much age pension is taxed. Age pension is part of retirement income for approximately 2/3 of retirees, so any deductions are right to be considered a tax. The first of the measures is deeming, set up to look generous and relevant. So, deeming is 0.25% for the first $53,000 of assets, then 2.25% for all balances above $53,000. The table shown displays the deeming amount at $100,000 intervals, that is, the amount that the assets are deemed to have earned. Next, applicable to deeming but not the asset test, age pensioners may earn $89 per week before being taxed at 50%. From that, most people would already have calculated in their head that at $252,800 of super, the deeming calculation comes to $4,628, which divided by 52 weeks in a year equals $89, the age pension income limit. So, if a single person has $252,800 in super and no other cash assets other than their home, which is not included, they are deemed to be earning $89 per week and therefore get the full pension. Up to this point, deeming has not saved one Australian taxpayer dollar. Just the retiree's ability to earn income has been reduced. And deeming looks generous because a super balance of $252,800 at 5% earns $12,640, whereas deeming calculates only $4,628. Therefore, to calculate the amount that pension is taxed or deducted, we take the deeming amount minus $4,628, then multiply by 50%. Now, we can calculate the effective tax rate of deeming. After $252,800 super balance, for every $1,000 in super above that, it is deemed by 2.25%, which is $22.50. Then, the age pension is taxed at 50% for that $22.50, so $11.25 is deducted. Now, during retirement phase, we are allowing 5% returns on super. For $1,000, that is $50. So the retiree has been taxed $11.25 from $50 income. That means the effective tax rate of deeming is 22.5% for balances over $252,800. More than reasonable. Now, on to the asset test. And I quote their words, reduces their age pension by $3 per fortnight for each additional $1,000 in assets. What a snake in the grass way to describe what is easily Australia's most punitive tax. Deeming assesses all of your assets. the asset test leaves the first $268,000 alone. So with deeming starting at $0 and the asset test starting at $268,000, when does the asset test take over as the higher tax? At $271,000. Therefore, deeming kicks in at $252,800 and then becomes irrelevant at $271,000. And at $271,000, the retiree still gets paid 99% of the age pension. So deeming applies for a very small window, and the biggest effect of it is 1% deduction of age pension. Basically, you could get rid of deeming calculation altogether, still keep the income limit, and it would make next to no difference. It is a total and utter smokescreen that applies to bugger all retirees, with bugger all effect for both retirees and government revenue. Back to the asset test. Using the $3 per $100,000 per fortnight, we can calculate the $100,000 intervals again. Note, unlike deeming, the calculated amount is 100% taxed. Therefore, at $583,000, the age pension is reduced to $0. But let's not stop there. I described the asset test to be a snake in the grass and Australia's most punitive tax. So let's show the numbers they should have used if they were trying to be upfront. $3 for every $1,000 per fortnight. $3 a fortnight equals $78 per year, only 7.8%. But that tax is on the principal, not the earnings. $1,000 at 5% earnings will earn $50. The tax is $78. That gives you an effective tax rate of 156%. Calling 156% punitive is an understatement, and using $3 in $1,000 to describe this bullshit is the very definition of snake in the grass. Just think logically. If you had $368,000 in super, $100,000 over the limit, you are going to be taxed $7,800 on that $100,000. Of course, any sensible retiree will spend $70,000 on their home and $30,000 under the mattress. These settings are distorting retirees' financial decisions. Worse still, by forcing retirees onto the full age pension, they are costing the Australian taxpayer money. In 2017, the taper rate was doubled from $1.50 to $3. The Retirement Income Review claims that there is no evidence of distortion of spending, and whilst that ignores logic, it also ignores experienced researchers Anthony Asher and John D. Raven. They claim that while only 19% are subject to the asset test, super balances over $271,000, over 1/3 should be in this category. If that incredibly stupid tax rate was returned back to $1.50 per $1,000, which would change the effective tax rate back to 78%, at least retirees could viably mix super with age pension. That in turn would save Australian taxpayers money. Who does this hit? Well, average retirees. My average income earner above ended up with a super balance of $363,034. Also, according to the Australian Bureau of Statistics, in 2018, the average super balance for those aged 65 to 74 was $446,600 for men and $378,600 for women. The gap between super balances for men and women is stark. The Retirement Income Review mentions the 17% pay gap between men and women full-time workers, and that women account for 93% of primary care leave. These imbalances are 100% cultural inequality. Cultural inequality needs strong leadership to correct it, and Liberals, with 22% women sitting in Parliament, represent an even more skewed cultural inequality than these super balances do. I would like to defer to Julie Bishop, Liberal Deputy Leader from 2007 to 2018, and also very much respected on both sides of Parliament. Let's use her words to wrap this brief gender commentary up. When asked if Liberal will ever elect a female leader, Julie Bishop replied, "When we find one, I'm sure we will." And like Julie Bishop, let's move on. Wombat Politics would like to suggest a new key observation to start the Retirement Income Review. The Australian retirement income system is ineffective, naive, and its costs are broadly misconstrued to divert attention away from billions of dollars going to the top 1%. Billions of dollars to the top 1%. A throwaway line, surely. Try again. On pages 20 and 40 of the Retirement Income Review, an almost identical paragraph. Not a big paragraph, more of your 61-word, 5 numbers and a little punctuation paragraph. Referring to super, it simply states that at June 2018, more than 11,000 people with a balance of 5 million or more. Then, on page 40 only, these balances cost ATO around $70,000 each. My calculation was $75,000, but let's go with $70,000. Does the report elaborate on this? No. No further analysis, comment or thought provided, not even a total dollar figure. But I will. So, 11,000 people at $70,000 cost each is $770 million. I could go on about $750 million tax dollars being channeled every year to the mega wealthy. But first, let's just note that 11,000 people is 0.04% of the population. For clarification, you have to multiply by 22 to get back to 1%. At $770 million cost to the ATO, they are getting $29.86 from every man, woman and child in Australia. But that is not accurate. We would need to consider how big some of these 11,000 balances get. According to a March 11th, 2016 Australian Financial Review article, there are 6 people with super balances over $100 million. 6 people costing the Australian Tax Office $8,400,000 in unfair tax concessions. You get 100 million. 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 Sorry. Back on topic. When you consider the range of balances that occur between 5 million and 100 million, it is conservative to suggest that the real cost of mega super balances to the Australian taxpayer is $1 billion per year. Please note, in 2017, the super $1.6 million transfer cap to retirement phase was introduced. Prior to that, these balances were 100% tax-free rather than highly concessional. Prior to 2017, that tax-free status at least doubles the cost to $2 billion per year. That means every man, woman and child in Australia was donating $80 per year to the mega-rich. But that doesn't even elicit the smallest amount of analysis from this wonderful report. Instead, this report is fully focused on 2 liberal agendas. 1. Holding super guarantee payments at 9.5%. 2. Telling retirees to be more efficient with less super. There are examples. Page 18. Saving for retirement involves foregoing consumption in working years. Page 18. Increases in the super guarantee rate result in lower wages growth. Oh, that does make super sound bad. Page 19. More efficient use of savings in retirement can have a bigger impact on improving retirement income than increasing the super guarantee. See, do more with less. Page 37 to 39. Maintaining the super guarantee rate. Page 75 to 79. Overview of compulsory superannuation. Page 205 to 231. Section 2D. Policy scenario implications of maintaining the super guarantee rate. See, this report can elaborate when it wants to. Why are Liberals so intent on sending people into retirement with less? Rather than increase super, they want to tell retirees how to spend their super. Makes me think of an October 7th, 2020 7:30 report interview with Scott Morrison, Honourable Member for the Rich and Powerful. In regards to stimulus payments to middle and lower income earners, he stated that we will never tell an Australian how to spend their own money. Well, why so focused on how retirees spend their money? My favourite gem in all of this is bottom of page 37. Projections suggest that maintaining the super guarantee rate of 9.5% would lead to lower superannuation balances at all income levels. Really? They only suggest lower balances. Are you sure? Hang on. Let me check. 1, 2, 3, 4, 5, 6, 7, 8, 9, 9.5, 10, 11, 12. Yep, I would suggest that 9.5 is less than 12. And it makes me ask, who wrote this book? Well, it was a 3-person panel. Mike Callaghan, previous job, Peter Costello's Chief of Staff. Next, Miss Caroline Kay, banker, lawyer, executive. One for the common people. Lastly, Dr. Deborah Rouston, an academic. Well, an academic raises the bar for perspective. It gives us some hope. Except, according to an Australian Financial Review article on September 30th, 2019, Industry Super Australia objected to only one of these people, Deborah Rouston. They had, and I quote, serious concerns about Deborah Rouston's ability to conduct an independent inquiry. It seems she had a slanted view on super guarantee being voluntary for low-income earners. Then we have, page 18, key observation. Saving for retirement involves foregoing consumption in working years. With voluntary saving, people decide on this trade-off. See, that's how it works in liberal land. Low-income earners can just decide to save for retirement. That, or a new Maserati, or luxury yacht, so many great choices. So, in summary, we started with a liberal stalwart, added an incredibly wealthy and successful banker-lawyer executive, and the third person was most objected to by Industry Super Australia. Then, not surprisingly, this panel glosses over billions of dollars going to the top 0.04% in 61 words. But the true glossing over was saved for the huge pension poverty issue with renting retirees. It was raised on page 18, 32, 33 and 34. Page 32, if you are a single pensioner who rents, 60% are below the poverty line. The review estimates that increasing rent assistance by 40% would cost $400 million. This is in stark contrast to Anthony Asher and John DeRavin, who are actually trying to help this poverty issue. They stated that doubling rent assistance to pensioners not in social housing would cost less than $200 million. But even at $0.4 billion cost, we are donating 2.5 times that to the mega-rich. They then go on to mention that in total, all rental assistance costs $1.7 billion per year, which, like shonks selling $15,000 light machines, is 100% irrelevant to a retirement income review. But clearly, rent assistance of any type is a thorn in the side for this panel in general. But in the finest display of the sky is not blue type of logic, page 34, a paragraph titled Increasing Rental Assistance, I will summarise. Renting pensioners are under significant financial stress, but rent assistance will not help. And finishes with, an alternative approach to assisting lower income renters in retirement may be required. Just maybe. So, increasing rent assistance will not help renting pensioners. But next year, $1 billion going to the top 0.04%, A-OK. For many of them, if we at least gave back the super that is stolen off low-income earners, that would help the problem. Single renters like Maggie, who get the maximum $70 per week rent assistance, $3,640 per year. Good luck if you live in Sydney or Melbourne. But I'm being unfair, because in the foreword, the review was not asked to recommend changes to the system. See, they couldn't say anything about the billions going to the mega-rich, or help fix pension poverty. But they do seem to propose a change on page 53, under Measures to Improve Sustainability. Extending earnings tax to the retirement phase, it will simplify and make it all more sustainable. And improve equity. Sounds great. Let's apply this great idea to the $100 million mega super account and Maggie. The mega account of $100 million super would be taxed an extra 15% on just 1.5% of their super, a tax increase of 0.00225% on their super earnings. And Maggie, who is struggling with $109,782 of super to live out her life, who has already been taxed unfairly and had $12,615 stolen off her by the ATO, these knobheads want to increase her tax burden by 15% on her entire and meagre super earnings, 66 times more than the $100 million super account. I could just say, what knobheads, but that would be easy. Instead, what will help? Wombat Politics proposes the following 6 changes. First change. When you get to retirement, the government lets you transfer up to $1.6 million into a tax-free retirement phase. They then let the remaining balance stay in a 15% accumulation phase. Wombat Politics proposes no super over $1.6 million. Full stop. You get to transfer $1.6 million to a tax-free retirement phase, and that is it. Everything else is in the normal tax system. You have received hundreds of thousands of dollars in tax-funded subsidies. That is it. No more. Second change. Super income should be accessible. When considering all retirees, not accessible does not help those on a pension. Then, if you mostly rely on super and little other income, the not accessible status still does not help. Lastly, those with significant income outside super, it does help. But it helps those over 1.6 million a lot more than those under 1.6 million. The tax ruling is perfectly set up to help those at the top with a total free hit, paid for by everyone. Third change. Restructure super tax policy concessions. Currently set up to funnel billions to the top 5% and do bugger all for minimum wage earners, and worse still, screw over primary carers and low-income earners like Maggie. How? We structure super tax policy concessions around the minimum wage, rather than screwing them over. People on minimum wage are the bedrock of a competitive economy and cheap goods and services. Everyone benefits from their contribution, so super should be set up to help them, not ignore them. Base super tax policy on minimum wage earners. That means minimum wage super equals tax-free super. Calculate super balances for minimum wage earners, but reduce the contributions and earnings tax to zero. This means they end up with $270,181. Therefore, make super balances for everyone up to $275,000 tax-free. When the super balance reaches $275,000, all earnings and contributions are taxed at 15%. Then, double the $275,000. When you reach $550,000, all earnings and contributions are taxed at 30%. Up to $275,000 will protect minimum wage earners and low-income earners and primary carers. And by not giving away billions to the mega wealthy, it is affordable. Let's look at what it does to high-income earners. Because their super is tax-free at the front end, their super balance after 46 years increases from $733,214 to $835,981. What is interesting, they end up paying more tax, from $129,391 up to $169,348. The balance grows quicker at the front end, and that generates more income, and that ends up collecting more 30% tax. For those that go over $550,000 balances at 30% contributions and earnings tax, it is still beneficial for these people and Edna to max out their super and receive the tax-free status on their retirement income. Importantly, from $550,000 to $1.6 million, the tax breaks given are a far more reasonable cost to the ATO. So with this method, the minimum wage and the mega wealthy get the same amount of tax-free super. And then the medium income, high income and mega wealthy get the same 15% super. Fourth change, the asset test. We must return the taper rate back to $1.50. Smashing super and cash assets at an effective tax rate of 156% and then claiming it doesn't distort retirees' spending decisions is a dazzling display of naivety smothered with bullshit. Most importantly, by returning it to 78%, it allows retirees to combine super and age pension in a sensible way, which in turn will reduce reliance on age pension. Also, remember change 2? We hit the group with super between $583,000 and $1.6 million when we got rid of the not accessible status on super. This change will help them in a reasonable way without handing tax-free status to people like Edna with $1.6 million super or more. Fifth change. Well, not so much a change, but we need to keep progressing the super guarantee towards 12%. It will help the bottom 75% enormously. Not doing this is as silly as suggesting 9.5 might be less than 12. Sixth change. Double pension rent assistance for renting pensioners. 60% and 25% pension poverty rates are a disgrace that we must act on. By the way, increasing rent assistance to those struggling with rent will help. Now, with those 6 changes completed, I would like to finish with 2 comments about sustainability. 1. If change 3 is still costing too much, ratchet it down. But if you ratchet the $275,000 bracket down, the $550,000 bracket should be maintained at times 2. That is, if the $275,000 bracket drops to $200,000 and the 15% contributions and earnings tax kicks in, then the 30% bracket would kick in at $400,000. Watch them find a way to keep it at $275,000 under that scenario. 2. The next episode will also help. Franked dividends, one of Australia's greatest tax reforms ever, that was then twisted into a ridiculous and enormous rort. Final word. Super tax policy sucks and sucks hard. But just importantly, so do some super funds, compared to others. I quote selectingsuper.com.au article, Super Fund Performance News, 2019-20. The best super funds achieve investment incomes double or triple those achieved by the lowest. Fees matter a lot, especially to them. The super industry rakes in $30 billion of fees every year for not doing that much, costing $1,200 per year for every man, woman and child in Australia, and in some cases, costing some dead people too. If you only take one thing from this long-winded blurb on the complex and boring, take this. Find a decent super fund, one with low fees. And, in news just in, I will finish giving some due credit to Scott Morrison. On 17th of June 2021, legislation has just passed scrutinising rubbish super funds. An Australian Financial Review article on June 18th estimates that 3 million Aussies will be soon told that their 21 super funds are a dud product. This is a good step forward for all super accounts. So, great news. Super tax policy and part 3 are finally done. And if you can get through that one, everything else is downhill from here. Thank you and have a good day from Wombat Politics.